Imagine getting paid a salary for just holding investments in your ISA. What if I told you that there are ETFs doing exactly that and they're perfectly legal for UK investors? By the end of this video, you'll know exactly what dividend ETFs could help you build real passive income. I'm sharing some of the top ETFs for UK investors. I'll cover 3 dividend ETFs, how to avoid the tax traps that catch most beginners, and a simple strategy you could use to actually make money from these investments. Dividend ETFs give you a simple, easy way to own a tiny piece of hundreds of companies all at once. And these aren't just any companies. They're businesses that regularly share their profits with their owners. That's you, but only if you buy the ETF. According to research from Vanguard in 2024, dividends have made up about 40% of total stock market returns over the long term. Most beginners completely ignore this and only focus on whether the share price goes up or down. Before we get into the ETFs, we need to touch on tax. In the UK, you get something called a dividend allowance, which means you can receive £500 in dividends without paying any tax annually. Anything above that, you're paying dividend tax. But here's a great tip that will save you a ton of money. Put these ETFs inside your stocks and shares ISA. An ISA makes all your investment income and gains tax-free. No tax on dividends, no tax on growth. Nothing. You can put up to £20,000 a year into an ISA. According to HMRC data from 2024, around 60% of UK investors don't use their ISA properly. Don't be one of them. Something worth knowing is that some of these ETFs hold American companies. The American government actually takes 15% of those dividends automatically before you even see them. It's called a withholding tax. Even if your ETF is in an ISA, you can't avoid this one. I'm telling you this now so you're not shocked when your expected 4% yield turns into something a little bit less. But it's worth being aware that this withholding tax isn't all doom and gloom. Being exposed to these much larger, bigger paying corporations can actually be more beneficial, so don't let that withholding tax scare you away. First up, we've got the Vanguard FTSE All World High Dividend Yield ETF. The ticker symbol is VHYL. This one currently pays about 2.9% per year, and it holds over 2,179 companies from all around the world. What I really like about this one is how spread out it is. You get to UK companies, American giants like Coca-Cola and Johnson & Johnson, even companies from countries like Taiwan and South Korea. This means if one country's economy struggles, you've got companies in all other countries still doing fine and paying dividends. Pays out quarterly, so 4 times a year. The fee is only 0.29% per year, which means that for every £1,000 you invest, you pay £2.90 in fees annually, which is pretty cheap. Looking at performance, over the last 5 years, this ETF's total return, including dividends, is 84%. And without dividends, it's 55.8%. A 2.9% yield is quite low, which suggests it might be a higher valuation at the moment. But this ETF would suit you if you want to spread your risk across the whole world and you're happy with steady, reliable income. You can buy this on basically any UK investment platform. Vanguard's own platform, Investor Engine, Trading 212. Just search for VHYL. Next is the iShares UK Dividend UCITS ETF, ticker symbol IUKD. This one focuses purely on UK companies and currently pays about 5.2% per year. This ETF holds about 50 of the biggest dividend-paying companies in the UK. We're talking about businesses like Shell, HSBC, British American Tobacco, and L&G. These are huge, established companies that have been around for decades. The beautiful thing about keeping it all in the UK is there's no American withholding tax. Every penny of the 5.2% dividends is yours. Plus you don't have to worry about currency bouncing around because everything is in pounds. It also pays quarterly and the fee is 0.40%. Now the trade-off is you're putting all of your eggs in one basket, which is the UK. If the UK's economy struggles, you feel it more. Also, this ETF is quite heavy in certain sectors, particularly banking and the energy companies. Its total returns including dividends is 108%, but without the dividends reinvested, only 56%. So a big difference there. This is where you can really see the power of reinvested dividends. This is your pick if you're specifically confident about UK companies. You want to avoid American withholding tax and you want the higher yield. This works great for people who are closer to retirement potentially. Lastly, the SPDR S&P Global Dividend Aristocrats ETF, with ticker symbol GBDV. This one's special because it focuses on companies that have increased their dividends every single year for at least 10 years straight. These are companies that even during recessions and downturns not only kept paying their dividends, but actually gave their shareholders a raise every year. This ETF holds about 100 of these companies from around the world. The yield is currently sitting at about 4.1%. It pays its dividends quarterly, and the fees are a little bit higher at 0.45%. The 5-year total returns for this ETF is 60%, but the 5-year return excluding dividends is only 30%. So again, you can see what a big difference the dividends make to the total returns. But what makes this one powerful is its dividend growth. While a 4.1% yield today might seem lower than the 5.2% UK option, these companies are increasing their payments every year. A study by Hartford Funds in 2023 showed that dividend-growing stocks beat non-dividend stocks by an average of 2% per year over long periods. So that means that your 4.2% today could be 5% next year and 5.5% the year after. But the downside is the same as the global option. American withholding tax applies. Also, it might grow slower during wild bull markets. This ETF is perfect for younger investors who have time on their side. If you're building for the long term, the dividend growth aspect can be incredibly powerful. So here's something critical. Don't just chase the highest yield number. I believe getting the balance between yield and growth is crucial. Ideally, you want something that will continue paying out and hopefully increasing the dividends for many years to come, as well as the price growth. There are some funds out there promising extremely high yields of around 10%. But when you take a closer look at the performance, the return without dividends is actually losing money every year. This is known as price decay, and you want to avoid this at all costs. So what's a simple strategy to get started? Let's say you've got £5,000 to invest. There's two main ways to get invested. Firstly, pound cost averaging into the market. This means spreading your investment buys over a time frame, maybe over 4 to 5 months. This way it takes stress out of trying to time the market. Secondly, buying all in one go. For longer time horizons, this can be less risky, as the longer you're invested in the market, the lower the risk there is of your investment actually losing money. Another question is, should you reinvest your dividends or take the cash? This really depends on your investment goal. If you don't need the income right now, then reinvest everything automatically. Let the dividends buy more shares, which in turn pay more dividends, which buy even more shares. It's a beautiful cycle. But if you're getting close to retirement or you actually want the income, just don't reinvest the dividends. Withdraw the cash every quarter when the dividends arrive. Let me tackle some questions that I get asked constantly. Are dividends pointless? Dividends give you actual cash flow. You can't pay bills with unrealized gains. Dividends put real money in your pocket while you wait for growth. Sometimes it's also not the most tax efficient to sell your stocks, realizing the gains. What if I need my money before retirement? These ETFs are completely liquid. You can sell them any day the market's open and get your money within a few days. Is 3 to 4% even worth it with inflation? When you add dividends plus the growth of the share price, these ETFs have historically returned 7 to 10% per year total. That beats inflation and definitely beats cash in the savings account. So here's what I want you to do right now. First, check if you've got room in your ISA allowance. If you haven't used your full allowance this year, that's where these ETFs need to go. Second, pick 1 or 2 ETFs based upon your situation and investment goal. Don't overthink it, just get started. Third, set up a regular monthly investment, even if it's just £50 or £100 a month. Small and consistent beats large and irregular every time. I've put links to the investing platforms I use in the description below. These are affiliate links, and I actually use these accounts, so recommend them based on my own experience. If you enjoyed this video, don't forget to like, comment and subscribe, as this really helps out this channel and helps me to keep making more content. Let me know in the comments which ETF you're most interested in. I read every comment and I'm happy to discuss any ideas. Remember, building wealth isn't about getting rich quick. It's about making smart, steady decisions over time. So if you're ready to go deeper, I've put all of my ETF videos into one easy playlist, everything I've learned in one place. Hit play and check it out now.